presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Market Wrap Weekly YouTube Update for February the 12th, 2024. I'm Mo Ansari, President of Compak Asset Management, and thank you for joining me today. Don't forget to subscribe to all the Compak communications. All you have to do is go to compak.com/media, and if you like this, just click on the like button. Every time I do an update, you will be notified, and then you can tune in and find out what I'm thinking and why. You'll also get the weekly newsletter. You'll get all the notifications of when I'm in town, when I'm doing seminars. Also, you can go to invest@compak.com if you would like to set up an appointment and come by the office. Let's start with the week. A great week last week. New all-time highs for the S&P. I always love saying that. For the week, we were up 1.4%. Above the 5,000 mark. I was not quite sure that we would get to 5,000, but we are there. I'll show you on the weekly chart. We're right in the Fibonacci projection zone on where we could get to on this rally, and we're there now. Today, we're seeing a reversal day to the downside. Now, if you get a weekly reversal to the downside, that means if the market goes above the previous week's high and then closes below the previous week's close, that would mean to me that we are finally starting the much awaited correction in this market. Everybody's starting to get bullish. Everybody's talking about how this market continue to go higher. But I think we've gone up so much from the lows that we set around 4,100 to where we are now to 5,000. We've nearly seen 1,000-point rally in the S&P since October. So it's time for a pause. And now all the people who are getting bullish, all the people who missed out, didn't believe in this rally all last year, who were looking for that recession, looking for the market to turn back because of interest rates going up and blah, 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 blah. Now all of those people are believers. Those are all the people who are the last to buy, and they are the ones who are left usually holding the bag. We get a pullback, usually February and March in election years are where we get the pullback, as I've shown you on the chart. So that's where we are. Technology is starting to lead to the upside. Again, last week was a great week for technology, up 3.3%. Consumer discretionary, second best, healthcare, third, and utilities were down 1.9. Oil was up sharply, up to $76 from the previous week's close of nearly 72. So we've seen a big rally in the oil market, but it was because of the tensions in the Red Sea, because of some of the increased tensions in the Middle East. I think this is going to be a short-lived temporary rally, but I'll talk about that when we take a look at the charts. Looking at fixed income, the interest rate market, looking at the 10-year, it has gone up from 4.03 to about 4.17. So it's gone up a little bit on the 10-year, and that did sort of put some pressure on the market overall. Inflation expectations are continuing to come down. The average 10-year average is 2.7. Now we're at 2.9, so we're there. And we're looking at 2.3 is the long-term forecast, latest forecast still 2.3. So again, we're getting closer and closer to that 2% level. The reason why we should have interest rates start to come down now, because real interest rates, when you take the interest rate adjusted for inflation, is at the highest we've seen it in a long, long time, the real interest rates. And I think the Fed has reason to bring it down. We'll have to wait and see. This week, last week, we saw the ISM. It went from 50.5 to 53.4. That is Institute of Supply Management. I look at that number because it's a forward-looking number. It's a survey of the biggest, the managers who run the largest corporations in the world. What are they thinking? What are they doing? And when they get more positive, above 50 is an expansion. Initial jobless claims fell to 2.8, so the labor market is still holding up. This week, the big number will be the CPI, the Consumer Price Index, and then we'll see how retail sales are holding up. So those are the two that we'll keep an eye on. Looking at the technicals, continue to march higher on the third wave for the S&P. This is an extended third wave. This is a second wave bottom right here. And from there, we've gone all the way up to here. A lot more. I thought we'd somewhere around 4,800 is where we would stop. Here we are at 5,000. And today we did go above Friday's high. We are negative now for the S&P. First support is around 4,900. That's the 20-day moving average. Then 4,780 to 4,800. This one is coming up, the 50-day moving average. So if we see a fourth wave pullback, which is wave 4, it could bring us down somewhere around to 4,800 plus or minus, because this line continues to come up. So as the market comes down, we could meet it. But first, we'll see 4,900, what happens there, if we do see a correction when we do. Now, this is the number that I was talking about earlier. I was talking about this 5,000 to 5,150. That's the Fibonacci projection from this previous high that we made in December or January of 2022. So it's nearly been 2 years since we saw this high. And this was the projection, 5,000 to 5,150. We are there. We got to 5,050, so we're in this band right here, and that's the Fibonacci projection. We're up there now. We'll have to wait and see. Once we start getting confirmations on the dailies that we have reversed down, that will set us up for that pullback, the correction that a lot of people are looking for. On the daily charts on the NASDAQ, 15.4 to 15.7 was the number. Well, we've sliced through that over the last week, but we are closer to a fifth wave high. What is the high that we could get to? 16,212 is the all-time high right here. That's what we set up in November of 2022. We are at 16,000, nearly 16,100 this morning. But again, we went to a new high, it reversed, we're negative now as I'm doing this broadcast, this update. Long-term target from this high is still 17,125 to 17,750, this band right here. But we're not there. Short term, again, we're at a fifth wave. Support is 14,750 and then 13,600. But both of these lines are moving to the upside. So if the market starts to pull back, these lines will be a little bit higher. But that's where I think we could get to somewhere around 14,000 if we do see a pullback or a correction in this market. What will cause it? We don't know that. That's some fundamental story that'll come out and say, oh, that's why we're seeing this pullback or the correction. One thing I am getting a little concerned about, the rates, interest rates continue to march higher this week, and that's what I'm looking at. It's 4.2. This high right here is where we got to again on Friday. We got there today. We got to 4.197. This high was 4.198, so we were very close to it, even though we backed off a little bit from here. But long term, I still feel this is the fourth wave up, and then we are going to see the fifth wave down to interest rates down to about somewhere around 3.7 to 3.6 is what I'm looking for. 3.7 is what the number really comes out to. But fourth waves are usually messy, choppy, they go back and forth, and that's what we're seeing right now in the interest rate market. Oil did come up, test the 50 to 200-day moving average a couple of weeks ago. Today, Friday we came and tested it. Today we are at the 200-day. But again, that is due to the tensions in the Middle East. I don't think the supply of oil, there's still plenty of oil out there right now. And as we're seeing the slowdown in the European economy, especially the Chinese economy, which is the largest importer of oil in the world, that could keep some pressure on the market. Plus, our production here in the United States is at an all-time high, which is also negating the cutbacks from OPEC. Small caps are having a great day today. They're up 1.5% on the day. As I had mentioned when we saw this pullback, I said this could be an opportunity for you to add this small cap. I still feel small cap will be one of the best sectors for 2024. That is my opinion. That is my thoughts. We'll have to wait and see if that happens or not. Target's still around 208 for this. We are at about 200, 202 today. Again, can it hold up if the S&P starts to pull back and the NASDAQ pulls back? We'll have to wait and see. But the biggest beneficiary of of small caps of interest rate declines will be small caps. Small caps are at 44% of cap value of the S&P. The last time we saw that was in 1999, and then we saw 12 years of outperformance by the small caps compared to the large caps. So that is why I think the small caps are somewhere, but you have to be very choosy. You have to pick and choose what small cap companies have the cash flow, have the balance sheet, have the technicals to be able to participate in this rally. So you have to do your research of what small cap companies, if you are going to add them to your portfolio. Those are my thoughts. Those are my observations. Don't forget to tune in to the broadcast, the podcast that Javed and I are going to do. That is 45 minutes and an hour jam-packed of information, what we're thinking, what happened last week, what we're expecting next week and in the future. So make sure you tune in to the podcast. Download the app. It's free, and you will get the free update whenever we do it. You'll be notified, and you can listen to it at your convenience. Just go to the Apple Store, type in Market Wrap with Mo Ansari. One word, Market Wrap, W-R-A-P with Mo Ansari. And you can, the app will pop up, download it to your iPhone, and then you'll get the podcast free every week. Those are my thoughts. Those are my observations. Thank you for tuning in. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.